Fed pressure builds as metal ignore rebalancing markets macro report. Key chart: stocks, oil, gold, silver, miners, DXY, and Bitcoin. Here's what's going on. The big picture, guys. Markets are increasingly repricing trust, not data. This week's price action reflects a clear convergence, weakening confidence in monetary institutions, rising geopolitical instability, tighter control over strategic resources, and growing demand for assets that sit outside political and legal systems. That's what's going on. Gold's advance is not being driven by inflation surprises or speculative excess. It's happening with limited investor participation, steady central bank buying, and greater sensitivity to institutional and geopolitical risk. Unrest is a key energy regions, and renewed focus on supply chain choke points are being access risk backed into the macro equation, increasing inflation, optionality, and political uncertainty. The near-term flow concerns, including the annual Bloomberg Commodities Index, rebalancing fit within the COMEX. These are mechanical, well-telegraphed events occurring inside a market that is structurally repricing credibility and control, not reacting to isolated headlines. This isn't a single catalyst move. It's a broader reassessment of how reliable the system itself has become. The institutional and credibility risk are converging. So markets are replacing a single theme through multiple channels, confidence in system management, and weakening simultaneously at home and abroad. In Iran, protests driven by inflation, currency collapse, and deteriorating living standards have escalated into the most serious international challenge to the regime in years. Demonstrators have spread nationwide, and the state response communication blackouts, mass arrests, and the lethal force signals authorities view the unrest as existential. For markets, the risk is not regime change per se, but escalation, miscalculation, diversionary external conflict, or accidental disruption to energy flows in an already inflation-sensitive global market. At the same time, U.S. Institutional credibility is under unusual strain, centered on the Federal Reserve. The Federal Reserve Chair, Jerome Powell, has forcefully pushed back against the Justice Department's investigation and the related grand jury subpoenas, arguing that the issue is not administration or procedural, but fundamentally the monetary policy independence. Trump just wants low rates to refinance all this high debt. That's why he wants them out. He's a real estate guy, but it doesn't matter. He's not going to get it. Not right now, anyways. Powell stated that while no official is above the law, the action should be reviewed in the broader context of the administration's threats and ongoing pressure, describing references to congressional testimony and Fed building renovations as pretexts. According to Powell, the real issue is the Federal Reserve is setting interest rates based in the assessments that serves the public rather than aligning with presidential preferences. Remember, everybody, these people are nothing but actors. For markets, the importance is not legal outcome, but the precedent that options that the federal authority rest on perceived political insulation and credibility of independence, okay? Got it? When the chair openly frames legal scrutiny and pressure tied to policy decision, it introduces uncertainty and around those assumptions. Markets are responding accordingly. Gold has become more sensitive to institutional and governance headlines as CPI or real yields. The dollar has struggled to fully monetize rate differentials, and volatility is appearing in place of historically stabilized by central bank credibility. Bottom line, oil doesn't need disruption. Gold doesn't need conviction, and markets don't need crisis, only doubt. When monetary independence itself becomes a variable, trust migrates elsewhere. So gold's advance reflects structural demand, not saturation. Gold's rally continues, so is silver's, to defy late cycle signals despite record prices. Participation remains thin. Participation with U.S. inventory portfolios and global EFT holdings remain well below prior cycle peaks. The marginal buyer is the move has not been momentum driven. It really hasn't. Financial capital. It has been central bank sovereign reserve managers and long-term duration allocators responsible to currency risk, as you can see above me, and institutional uncertainty. These distinction matters. Secular tops from when ownership is saturated. Here, price discovery is leading allocation, not the other way around. Supply dynamics reinforce the structure. Mine supply remains inelastic. Above ground inventories are increasingly spoken for, and the central banks act as non-price sensitive buyers. When Western financial flows re-enter via EFTs, they will do so in a tighter physical market. So the Bloomberg Commodities Index rebalancing concerns have centered on the annual BCOM reweighing schedule for January 9th through the 15th, which will mechanically reduce gold and silver weights. Following strong performance, estimates suggest 2.4 million ounces of gold may be sold via futures, and alongside approximately 3.8 to 7 billion worth of silver futures, an index linked produces trim overweight positions. So these flows are mechanical and time-bound and widely telegraphed, and therefore likely largely priced in. Notably, gold rose during last year's rebalancing under similar condition. Historically, such evidence tend to create short-term volatility, not trend reversals. Gold's behavior remains consistent with the framework responsible less inflation data than credible shocks. Bottom line, this remains an allocation phase driven by structural demand. Flow-driven weakness in gold or silver would represent noise within trend, not a bull market itself. And the story 3 is here. Strategic resources are being repriced through access risk. China's signaling around potential restrictions on rare earth exports highlights a broader macro transition. Resource markets are increasingly governed by political control rather than price. Rare earths are critical inputs across defense, semiconductors, EV, and advanced manufacturing. Concentrated control turns these materials into strategic leverage, forcing governments and corporations to prioritize access, redundancy, and inventory cost efficiency. This marks a clear break from globalization era assumptions. The emerging framework prioritizes security or supply. Does this make sense, guys? Even the expense or higher prices and low efficiency. This dynamic mirrors gold's role from the opposite angle. Gold benefits from neutrality and lack of counterparty risk. Strategic industrial materials expose the vulnerability of politicized supply. Bottom line, when access becomes the constraint, real assets price structurally, not clinically. I hope this all helped, guys. So let me know what you all think about this. Please like, subscribe, and share. And as always, stay safe, keep stacking, keep prepping, and God bless. And always keep watch. Thank you.